Peter Parker's worries have exploded tenfold since that radioactive spider turned him into everyone's favorite neighborhood Spider-Man. Saving the universe in Avengers Endgame probably doesn't give him much time to manage and invest his money, so we're putting together a simple 5-fund portfolio all you superheroes out there can use as a stress-free investing strategy. We're talking easy index investing today on Let's Talk Money.
Beat debt, make money, make your money work for you.
Creating the financial future you deserve.
Let's Talk Money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be with us. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, Spider-Man was by far my favorite superhero growing up, and I've been a fanboy since 1984. The socially awkward Peter Parker turned friendly neighborhood spider just gave us bookworms a lot to root for. Now, the 1-year wait to Avengers Endgame gave me a lot of time to think, what about those daily lives of our favorite costumed characters? What are they doing with their money, and what might the Avengers invest in when they're not fighting universe-ending bad guys? But Peter always seemed to have the most neurotic and stressful life, from never making enough money as a photographer to protecting loved ones in a tough relationship with Mary Jane Watson. Peter always had plenty to worry about, so I'm thinking Spider-Man would opt for that stress-free way to grow his dough. For that, I'm putting together a simple, stress-free portfolio of just 5 funds. Now, this strategy is going to give our web slinger all the diversification he needs in 3 different assets, from stocks and bonds to real estate. He'll get a great dividend yield and won't have to worry about that stock market crash while fighting the Sinister Six. That's a reference for the true fanboys out there. I'll be using Vanguard index funds for the portfolio because the company offers some of the lowest cost options available. The funds we'll be using will give you access to thousands of stocks, bonds, and real estate companies for less than 0.12% a year. That means an expense of less than $12 a year on a portfolio of $10,000. Now, I've got no affiliation with Vanguard and I get no commissions from recommending the funds. I've invested in them myself and recommended them to private wealth clients throughout my career. The first Vanguard index fund in our portfolio is the Dividend Appreciation ETF, ticker VIG. Now, the fund holds shares of 182 companies across sectors, some of the largest companies in the market like Microsoft, Walmart, and McDonald's. Now, the VIG pays a 2% dividend yield, which is only a little above the market, but it's balanced by that solid price growth. Over the last decade, the fund has produced an 11.2% annual return, which is one of the highest among Vanguard funds. It also gives you better exposure to some of those safety sectors like consumer goods and services, so it's not nearly as overweight in tech or other sectors you usually find in a growth fund. That exposure to safety sectors is important whether the stock market tumbles or you're fighting Thanos for the fate of the universe. Now, our next fund is going to complement that dividend fund, so we get a little bit more growth. Here we have the Vanguard Mega Cap Growth ETF, ticker MGK. Now, this fund holds shares of 120 companies and has produced a 13.7% annual return over the last decade. The dividend yield here is only 1.4% because the focus is really on stocks that grow faster rather than returning cash to shareholders. The sectors here are weighted to growth, so you've got more of that technology and financials and healthcare compared to the dividend fund. Now, I really like the combination here from the 2 Vanguard funds because you get solid dividends and price growth. Investing in these 2 funds gives you more of a balanced investment across sectors versus just investing in the broader market index funds. Now, a lot of investors avoid international stocks and think they get all their exposure they need from those large US companies. They're missing out on a huge opportunity for higher dividends and less risk though. Investing directly in international companies takes a lot of the risk out of that US dollar and other economic problems. You know, any company based in the US is going to be exposed to these, even if there's a lot of that foreign cash flow. So you really need to have at least one international stock fund in your portfolio. For that, I'm going to suggest the Vanguard International High Dividend Yield ETF. That's ticker VYMI. Now, the fund holds shares in over 900 international companies and pays a healthy 4% dividend yield. Now, what I like about this fund, besides that solid dividend and the average 9.7% annual return since inception, is the ability to get exposure to fast-growing emerging markets as well as developed markets around the world. The fund has half its exposure to relatively safe companies in Europe, but also 20% in EM stocks and Asian growth. Just those 3 Vanguard funds are going to give you all the stock exposure you need. Now, how much you have in these is going to depend on things like your age and investing goals. Most people are going to want somewhere between half to 65% of their portfolio in stocks, but now don't neglect these bonds and real estate funds that we'll get to next. These 2 funds for bonds and real estate are going to smooth out those risks in your stocks, provide some great cash flow, and even give you the opportunity to take advantage of lower prices when that next stock market crash does hit. For the bond part of our portfolio, we'll be looking at the Vanguard Long-Term Bond ETF, or ticker BLV. Now, bonds got smashed last year on the increase in interest rates, but have rebounded in 2019 and are actually beating stocks over the 6-month period. Now, the fund pays a 4% dividend yield and has 42% of more than 2,000 bonds held in U.S. government debt. All the bonds are in investment grade, so extremely safe credit ratings here. Our real estate fund here is my favorite, the Vanguard Real Estate ETF, ticker VNQ. Now, real estate is another sector that got hit on those rising rates last year, but the fund is held up and pays a 4.4% dividend. There's no better asset than real estate for creating long-term wealth. We've got another video on the channel covering the 7 real estate strategies I used after getting out of the Marine Corps to start with no money down. The problem is that even without having to come up with those tens of thousands down, property investing can still be a lot of time and work. Now, REITs, or real estate investment trusts, are a great opportunity to get that growth and the cash flow without all the work. The Vanguard Real Estate Fund has produced an 8.4% annual return since its inception in 2004 and holds shares of 184 real estate companies. This is a must-own fund for its diversification in every property type and in every region. That's it, just 5 investments, and our favorite Marvel superhero has his entire portfolio worked out. Spider-Man can sit back, put a little money to his investments each month, and dream about spinning webs with Mary Jane. If he's using M1 Finance, the investing site I'm using for our 2019 stock market challenge, he'll also save hundreds a year on fees and watch his money grow faster. Now, M1 Finance is a no-cost investing site with some great features, so I'll leave a link in the video description below to learn more. We're doing a whole series on Avengers Endgame investing, from Captain Marvel to Iron Man, Spider-Man, and the Black Panther. I'll leave a link in the video description below, but be sure to click that little red subscribe button so you don't miss a video. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just subscribe to the channel, scroll down, and ask it in the comments. We'll make sure you get an answer in a future video.